Hi, I'm Jeremy Wiseman,
And I'm Jerry Karaya.
and today we're going to talk about another aspect of gold that we'll hear sometimes at Guildhall, which is that it doesn't have any yield. Now, last week we were talking, Jerry, about the fact that gold is not an investment, it's a way to store wealth. And one of the reasons of that, of course, is because it's money.
Bingo.
So there are things that you can invest in. Obviously, any investment that have a yield has some risks.
That's right.
What are some of investments that people typically do, Jerry, that come with risks?
Once you put your money into the bank, that's a bank deposit. There's some risk there. Stocks, you're given a small yield, therefore you're depending on the performance of that company. That is risk, hoping that that company will turn a profit. Real estate, you are pulling a mortgage out of a bank. You're putting your trust in that bank, and thus you're receiving a little reward, your yield. But again, you mentioned that gold being money, money's cash, the money in the bank. You're not getting a yield on this cash. Money is a medium of exchange. Money is a store of value, and we know gold offers no yield. Why? Because it is money.
Yeah, exactly. And, I think in terms of bank deposits, we know that they put a bail-in clause into the budget in Canada, but they're very secretive in terms of, or not talking about what happens for depositors. And so I think that's something to keep in mind, that even though there sometimes is a yield on savings accounts of 1.75%, we also have to remember that you have to pay capital gains on that. It's not actually hitting the price of inflation, which we believe at Guildhall is certainly over 2%. Stocks, it's true, they've been buying back, corporations have been buying back their own stock. We're at record overvaluations on the stock market. We believe that that does come with some risk, especially since most people don't do due diligence when they're acquiring a stock. And then when it comes to real estate, there can be liquidity issues. We're talking investment real estate, liquidity issues, mortgage, if interest rates rise. So there's certainly risks associated with that. So we do believe that holding gold, even though there's no yield on it, it's not supposed to have a yield, it's actually an asset, it's money, is still something that should be part of your portfolio.
Absolutely. Gold is money, and it does not have counterparty risk. Because it's not an investment, it's a hard asset. What is your hard asset? That's why we believe it's important to own a little bit of gold, maybe 15-20% of your overall wealth in precious metals, tangible, hold it in your hand, precious metals. It may fluctuate. If the price drops, you allocate some more. That's how we just believe in a little bit of balance. And if you believe in balance, you need some gold in your portfolio, right?
Absolutely. And think long term. Think long term.
And guys, don't forget to like these videos, share the videos, subscribe. We really want to grow our page, grow our YouTube. Putting together these videos, our challenges are fun, and we want to ultimately just bring education out. We believe in education. Tune into The Real Money Show. Follow us, www.guildhallwealth.com. We'll see you next time, guys.